Geoffrey, I have three wives, and I want to get a house for each one of them, maybe 3 million, another one 3 million, another one 3 million, because I mean the limit is 10.5, right?
Yes.
How do I go about this?
Thank you, Paul, for that good question. The facility that KMRC is supporting is non-discriminative. So what we're saying is that if that is a family setup that you have, and of course you have documentation to support that kind of establishment, is that then we will look at you from a wholesale perspective. That one, you can support the three homes, but the kind of application then you make to the institution is that has to be within the 10.5, because the 10.5 million is per house, is household. And household, here we are looking at Paul and the three wife as one household. So what you do then is ensure that you're accommodating all of them within the maximum limit of 10.5. So you can do three houses for them at maybe 3.3 million each. But the application, the way it will be documented is that it is Paul and Jane as one facility, Paul and Rose as the other facility, and Paul and Jackie, just to use for argument's sake.
Yeah.
So those three then will be considered as three loans, but we know Paul is the primary, holder, because maybe you are the one who is servicing the mortgage, and that will be, quite accommodated.
Thank you, and hello there. Thank you for joining us on this podcast. Once again, this is a money podcast where we discuss everything about finances, savings, and today we have starting the new series on housing. We just want to understand the housing issues in Kenya and how do you actually afford houses. Many people have asked so many questions. For instance, isn't mortgage just renting from a bank, basically just changing your landlord? Other questions we've always received is that why are there so few mortgages in Kenya? And what are the risks around home ownership that are involved when you really get into the mortgage space? Why does it take so long to repay? Why are so few people affording mortgages in Kenya? Today we want to break that down, and I'm joined by Mr. Geoffrey Mwaura. Geoffrey, welcome to the show.
Thank you.
How have you been?
Quite good.
Yes.
Yeah, thank God.
Yeah, you've been out
Yes.
there and doing a lot.
Yes.
Yeah, so just who is Geoffrey Mwaura?
Geoffrey Maura is a finance professional. I've been working in this space of mortgage lending for the last 25 years. I'm a banker by profession and a finance expert. Initially started with banking at Housing Finance, then progressed to Kenya Mortgage Refinance Company. So I've been in the mortgage space for the longest.
Okay.
Yes.
And now you are at the Kenya Mortgage Refinance Company.
Yes.
Tell us, what really does KMRC do? And
Kenya Mortgage Refinance Company is a company that was formed as a public-private partnership between the government of Kenya and the financial institutions in this country. That is both banks, microfinance banks, and SACCOs. Primarily to address a liquidity issue in the market on mortgage lending. What was discovered that in this market, there was a serious challenge of mismatch between asset and liabilities. Just to make it easy for the understanding of everyone, is that banks borrow short-term from the public. They collect your money, your savings, which you put in your money, maybe your salary goes through there, or you have deposited money in a bank, which is for 3 to 6 months or 1 year. But the same bank wants to lend for 20 years or 25 years. So how do they do that? It becomes a challenge because then they cannot match the deposit they are getting and the loans they are giving out. So to alleviate that problem and to ensure that banks and SACCOs get into mortgage lending, KMRC was formed to come and address that mismatch issue so that by availing long-term funds to the institutions, then they are able to access those funds and lend long term to Kenyans.
All right.
Yes.
So is it a government company? Is it a parastatal?
It is a private institution with a government interest.
Okay.
That government owns 25% of the institution. The 75% is owned by private institutions. These are the banks, the SACCOs, and we have two DFIs, Development Finance Institutions. That is Shelter Afrique and IFC.
Okay.
Because also we have that international outlook. Yes.
Yeah.
So the way the company is funded is that we have 23 shareholders. Out of the 23 shareholders, 20 are financial institutions. And those are the ones that access funding so that they're able to lend. Because KMRC does wholesale lending. We don't do retail.
When you talk about wholesale lending,
Wholesale,
what
that
really
we are
does it
lending
mean?
to financial institutions so that they can on-lend.
Okay.
That we don't lend to individuals.
Right.
So we'll not come to Paul and say that we are giving you a facility as KMRC. But you can get our facility through a financial institution. So you can go to a bank or a SACCO that is participating for you to access an affordable home loan.
All right. So this is the Money Podcast. If you're just joining us, I'm your host, Paul Wafula. We are hearing for the very first time how really this wholesale lending works. So you basically have a pool of funds, okay? And you give this to financial institutions.
Yes.
And then they lend it to myself,
Kenyans.
to other
Yes.
Kenyans.
Yes.
I mean, so how much money do you have to, if we must start from there?
Just starting from our balance sheet,
Yeah.
we are in excess of 30 billion balance sheet.
Okay.
We have a credit line. We are funded by two main institutions, World Bank and African Development Bank. Okay. What the government did when it established Kenya Mortgage Finance Company, it negotiated for a concession of funding from those two institutions. So government has given a guarantee, say that we have this, avail this credit line to KMRC, and so that KMRC can be able to on-lend, manage the funds and ensure that Kenyans are getting affordable home loans.
Okay.
So that is how KMRC is funded. But also, we also get funds from the market. We go from time to time, we go to the market and issue a bond, a corporate bond. Yeah. So with that, we blend the funding, then we're able to on-lend to the financial institution so that they can avail the money to you and me.
I mean, Kenyans are afraid of mortgages, or I don't know if that is the right word to say, because if you look at the number of loans that Kenyans have taken through mortgages, they are quite countable. And you look at that from the population that really wants to own houses. What is really the problem with mortgages in Kenya?
I would say the numbers that are recorded today, because we have a report from the Central Bank of Kenya. When you look at the report like for 2023, the total mortgages in the banking sector stands at around 31,000. Of course, that is a drop in the ocean. It's only around 1.9% of the GDP contribution. However, we still have a very big portion of mortgages that are not recorded, because we have SACCOs that do a lot of lending for housing. And I know that number is even bigger than what we have for banks. We also have a lot of other loans that are given by financial institutions that Kenyans use to buy or purchase homes. So when I look at investment in housing, it's actually bigger than what we see recorded.
Okay.
Yes, and of course, that is because of certain challenges that we have seen in this market. When KMRC was formed, purely it was coming to alleviate that liquidity challenge in the market. Secondly, we found that the mortgage industry was not standardized. Yeah. That from different institutions, you'll get different way of doing things. And of course, KMRC came to address that by standardizing the process. So today you find that all the institutions that are participating with us have a standard way of doing mortgage lending. That helps. Secondly, fixed rate mortgages. That our funding is fixed rate. That if you sign up with any of the financial institution, the interest rate will never change for the tenor of the loan. Okay. So if it's for the 20 years, you'll pay the same amount. That helps you to plan your finances.
I think that is where really the rubber hits the road. When you talk about fixed rate, what are the current rates that Kenyans are getting through KMRC? And how do those compare with the market? And is it a reducing balance? Is it how much money can somebody really access when they really wanted to take a loan?
So when you look at our value proposition, is that there are four things we actually pride ourselves on. One is that we have introduced a fixed rate mortgage in this country. And what we mean by fixed rate is that the interest rate will not change for the tenor. However, it is on a reducing balance. That the loan you take, the computation of the interest will be on a reducing balance, but the interest rate will not change. Today, when you look at the commercial rates in the market, they fluctuate between 18 to 24%. So you can imagine, Paul, today, if you take a mortgage at 18% and your income, let's say, is 200,000, then next year your bank tells you we have increased your rate to 20%. What happens to you? You start now experiencing default because, of course, your income does not grow at the same rate. So the reason why we introduce a fixed rate is that then you're able to plan and you can actually get into this mortgage arrangement with certainty that your income will, we can only increase, as you grow in your industry. But your mortgage repayment will be fixed for that tenor. Secondly, when you look at the interest rate is actually below 10%. Yeah. Today, you are comparing that on average, the institutions that are working with us are operating between 8 and 9.9%. In fact, the highest now is 9.5. That is already a very big reprieve from what we are seeing in the commercial rates. Recently, you saw before a central bank started reducing the rates were actually hitting 20%.
Yeah.
So you can imagine at 20%, how many Kenyans can afford? Very few.
Yeah.
Very few. Yeah. You remember some years back, golden bag time, rates went up to 36%.
Yes.
Yeah. So 36% actually you are working for the bank.
Yeah.
Yeah. Each and every coin goes to pay your mortgage.
I mean, how much does somebody have to earn to be able to qualify for a KMRC loan?
There is no minimum and there is no maximum. So we are saying the Kenya Mortgage Refinance Company accommodates all Kenyans. The reason why we do that is because today it depends with what you want to buy or what you want to build. If your income allows you to build a house worth 1 million, then go for that. If your income allows you to get a mortgage, the maximum, what we have put is a maximum mortgage amount of 10.5 million. Because also we understand we want to serve the unserved. We want to push lending down market to the SMEs, to the informal income people, to people who are earning a certain less than what a normal Kenyan what you'll call up market or middle income. So we are operating at middle and lower income brackets.
Yeah.
That is why we say that you take a maximum mortgage of 10.5 million. That is what we accommodate.
Yeah.
So for every Kenyan who is borrowing at 10.5 million and below, they are free to walk into any of the institution and get a mortgage.
Yeah. So if you're joining us, this is the Money Podcast. I'm your host, Paul Wafula. Today we are discussing housing, and we are going to have a series on housing. We want you to understand just how to get these cheap and affordable houses in Kenya. I mean, if there is something big that has happened in the space of housing in this country, then that has been KMRC in the last few years. But do we have enough money as KMRC to give loans to all these Kenyans who are looking for it? And as even we get into that space, the biggest thing that Kenyans really would like to understand, and the question I always receive is that how do we get a KMRC loan? Yes, we know it's 10%, it's 9.5%, and there are those who are giving even as low as 8%, as you've said. How do we get this 8%? How do we get this 9%?
Paul, this money is available to all Kenyans. Actually, what you need to do is to walk to any financial institution in this country and ask for a Kenya Mortgage Refinance Company facility, KMRC facility. And actually, you will go through the normal process of lending because we have availed this funding to all institutions. At the beginning, we were lending to 20 institutions, but in the recent 3 months, we have opened that up to more participants, meaning that all banks and all SACCOs that are regulated and doing deposit-taking SACCOs are free to join KMRC. Yeah. So I know they're at different stages of engagement, But today you can actually access KMRC funding from any of the institutions that are with us. And to begin with, you can even look at our website and you'll be able to get information on who has money today.
All right.
And that is on www.kmrc.co.ke.
So here you have listed the banks and the circles that really
that actually are accessing funding.
Do I have to be a member of a certain bank for me to access it? Like if I'm
No.
a bank with, let's say KCB or Stanbic.
The beauty with this model is that, of course, I know for circles, they would want you to be a member before you access, but there is no time period. You can actually become a member today and you start the process.
Okay.
So for a bank, you'll start the engagement. You don't need to be banking with the institution, but as one of the conditions, they'll tell you, now for us to give you a facility, then you need to channel your income through us.
Yeah.
But at the beginning, they will be able to assess your affordability using whatever bank statements you have from wherever you've been banking.
Yeah. So what we understand is that you've moved away from just there were 8 banks.
Yeah, 8 banks and 11 circles and 1 microfinance bank.
Now any bank,
any bank can participate.
Yeah, this is big. So it means any bank in Kenya today can join. Is there any process for them to join?
Yes, there's a process for them to engage. And actually, most of them have actually engaged KMRC. And we are in the process of onboarding. They just need to express interest. And then we start the process. Of course, there are contracting process that we need to review their eligibility criteria, whether they qualify to participate. And we take them through that process. And I know majority of them qualify actually to participate.
Geoffrey, there are those who feel or who believe that taking a mortgage is basically changing your landlord. So there are those who think that when you take a mortgage, you're basically moving from maybe your day-to-day landlord that you know to a bank. And banks can be very vicious when they come to you. Your landlord, you might have a chance to negotiate, but banks are very vicious. So what is your take on this?
I look at it totally differently because today when you look at the relationship between a tenant and a landlord, is purely the landlord looks at you through the lens of the rent you are paying. And if you fail to pay that rent, then you'll move out. But when you look at a mortgage, the property sits with you. You are actually the legal owner of that property. The only thing the bank will do is register an interest in the property and say, we have financed this property and therefore we have an interest in this property. But the property belongs to Paul. So when you look at the title for those mortgages, the title belongs to Paul. Oh. But there's an entry down there saying that HF or KCB has mortgaged or has a charge of Kenya shilling 10.5 million over this. And the day you pay off that charge, then the property resorts to you. Secondly, if you want to do those improvements on your properties, you are free to do so because you are the legal owner. That is why you see you go and borrow additional amount, or you can save additional amount and you come and do a perimeter wall, do a servant quarter, improve on your house. You want to change the whole complexion of your house, you can actually change. And you don't need, the bank does not have any objection to that. So you can actually do those changes. Will you do those changes if you are a tenant? No, right. You will not. So you actually improve the quality of life when you look at a mortgage than what you can do if you are a tenant. Okay. Secondly, the payment you are making towards your mortgage goes towards building capital on your property. If today you buy a property worth 10.5 million, in another 5 years, you'll be talking about a capital appreciation. That property will have improved value to maybe 20 million, whereas your loan has actually reduced to like 7 million. So you are creating wealth through a mortgage as opposed to being a tenant. If you're a tenant during COVID time, what happened to most tenants? They were actually kicked out, you see. And they have no claim over the amount of money they have been paying as rent. They will not go and tell the landlord, unajua nimekuwa nikilipa hii, so you need to give me a certain percentage as a goodwill because I've been a very good tenant. Yeah, the day you stop paying, you're out. But for a mortgage, you can actually even go and negotiate with a bank in situations where you are unable to continue with the payment. You actually sit with the bank and say, yes, I know I took 10.5 million. Now I have a balance of 5 million. How do we, restructure this facility? They can restructure and tell you now, instead of paying 100,000 per month, what can you afford? Can you now start paying 50 and we extend the facility and restructure it so that it accommodates your cash flow?
Okay.
That is one option. Second option, if you are unable to continue with the mortgage totally, that now you want out, you have an option of selling. The bank can give you an option of you looking for a buyer in the private, we call it a private treaty sale, that you go get a buyer and you come and, the buyer will pay back to the bank the balance of the money remaining. Then the other money belongs to you and you move into another investment.
Yeah.
So that's how you get equity out of your investment. You will never get that through a tenancy agreement.
All right.
You get?
Yeah.
Thirdly, when you take a mortgage, there's what we call interest relief. On the income tax that you pay every month, KRA has told you that for the interest that you are paying on your mortgage, you actually is a tax deductible. So when you are computing your tax, your payee, you remove that from the income that you are going to tax. That is still a benefit that the government has actually allowed on Kenyans who have mortgages.
So that you do during the filing of annual returns?
If you are an SME, is during the filing of the annual returns.
Okay.
If you are employed, your employer then deducts that at the point of when they are paying you a salary.
Okay.
Yeah. So you get that benefit directly.
All right. I see you have you are in at least 36 counties, and I mean, to access KMRC across the country, the point of contact must be through a bank door, or through a SACCO.
Yes.
Is there any other way? I mean, there are Kenyans who want to have all their transactions on mobile. Must I go to a bank?
You need to access the funding through a bank.
Okay.
And when you go to a bank, is that the bank, when you look at our regulation, how KMRC was formed, we are regulated by Central Bank of Kenya. Yeah. And the regulation says that our lending can only be channeled through a regulated financial institution, because also we have to manage risks. So because of that, then we work with the banks and SACCOs. So those are our outlets for Kenyans to access funding.
Yeah.
But they are in all counties. So they are in all counties, and you can actually get funding from wherever you are. Yes.
Okay.
Thirdly, you don't have to have put all your money through a bank or a SACCO. If you have an M-Pesa statement, they still review the same, and for your qualification. So they will use any other method of assessing your credit worthiness. Using your M-Pesa statement, they even look at how well you've been paying your rent. That is record actually they can use to confirm that you have ability to service your mortgage.
I am those who will not go and buy a house that is probably ready done. I want to own or buy my own piece of land and then build it to whatever structure I need. Is there a facility? Does KMRC also help those who want to buy and build? Or is it just restricted to those houses that have already been developed by probably a developer, and then we go and buy them? Some of us will not want to buy an apartment. We want to have a standalone in our own environment. Maybe I have property, I have land that I've inherited from my family, and I want to build. What are the options?
Actually, the option, when you look at the options available for ownership, there is a purchase from a developer, or a purchase or an outrightly built property. There is a construction facility that is, supported by our financial institutions, and there is what we call buy and build. So for Kenyans who already own plots, they can get a facility for construction. So you go sit with the financial institution, and they will appraise you. You must have done, drawings to confirm that this is what you want to build. With those drawings, also it comes with bills of quantities to confirm that for this mansion that you want to build, it has been quantified. The values have been quantified to say that it is going to cost you X amount of money. Once you do that, in certain areas, you require to have approvals. Either the local approvals from the county, or if it is Nairobi, then you go through the county approval. In certain areas, you don't have to have approvals. Yeah, so it depends with which jurisdiction you are looking at. So once you have all that, then you present those papers to the bank. They will assess and to confirm that the amount you are borrowing is adequate to, construct that unit. Then once they confirm that, they will appraise your facility. Then they will do what we call stage disbursement. They can agree that for this house worth 10.5 million, they will break it in 5 stages or in 4 stages, depending with what you agree with them. Stage 1 could be just the foundation that you're doing. Stage 2 could be the superstructure, the walls and all that. Then you move now to the roofing. Then the final stage is the inside, the completion, the furnishings and all that. And you have your ready house. So that is supported.
So you're saying that I go to the bank.
You go to the bank
with my plan,
yes,
my title,
yes,
and I say I want to build.
I want to build on this piece of land.
This piece of land.
Yes.
And then the second thing is that the bank now looks at my plan, assesses it, and decides this is actually
doable. This is the amount. This amount that because when you look at the quantities, they are given by professionals, a quantity surveyor. They will cost the plans and say for these plans, 10.5 million is actually enough to build this. And they will even give the segments. Say that walling will cost these, finishings will cost these, electricity fittings, plumbing will cost all those things, roofing will cost this, and all those values are put there. And that is what now the bank will actually review and say this money is enough. And then they start the process with you.
All right. So I say foundation. They give me money for foundation.
Yes, they give you money for foundation. Okay. Once you've done with the foundation, you tell them, I'm done. They'll actually come and inspect.
Okay.
They'll come review and say, yeah, you have used the money as per plan. Then we go now to the second stage. We give you money for the next stage.
Okay.
Until you finish.
At that point, am I already paying interest on the money
so at
I've
that
been
point,
given, or what
most
happens?
of the banks, what they do, depends with how the bank is. Yeah. Some will give you a moratorium. They tell you, for the time you are constructing, we will not charge you anything. They'll give you a grace period.
Okay.
Others will tell you, we are giving you a grace period you will only pay interest for the amount you've accessed.
Okay.
So if the first amount is 1 million, you just start paying interest for that 1 million progressively. Okay. Then once you are done with the construction, they consolidate the whole loan, and then they amortize it. They spread it now for the 20 years.
Yeah.
Then now that's the point now you start now paying the actual repayment towards the loan. Okay. So there are various ways, and all that will actually be laid down when you discuss with your financial institutions.
There's always a big debate about either buy and build or just find something that is ready from the shelves. From where you sit as an expert of many years, what will you advise somebody who wants to own a house? Is it cheaper for you to buy and build? Is it better for you to buy a ready-made?
I would say that depends with the personal interest, because there are personal preferences. There are people who, because of their nature, they are not very good at supervision. They don't have time to chase around and work with fundis and work with models, and therefore buying an outright built house works for them. And also depending with where the location of the property is. For an outright purchase, you might get very good locations, maybe upmarket and all that, where because now when you look at the setup, maybe it's an apartment, so the value of land, when you distribute it to the number of units, it's affordable. You can afford it at that point. There are people from the school of thought that they want to create their own, and it gives you a lot of value. You feel nice about it, that you've created from scratch. You go identify a plot at a location that you want, because you have that kind of insights. You get a plot in maybe a gated community. You go design the house the way you want it. Yeah. So you are able to implement your dream in that house. So it depends with you as a borrower. So go for what works for you.
Okay.
That's what I would say.
Yeah.
But with all factors held constant, you might find that building might save a bit.
Okay.
Yeah, you might find that it's a bit cost effective if you build. because you're able to manage certain aspects and you get a customized house the way you want it.
Yeah, that's what I thought. Because
Yeah.
somebody will build and sell it to me. And
Yes, of course, they're putting a markup
a
on
markup
it.
on it.
Yes.
So it has
But
to be
also, they
slightly-
are also experts in that area that actually, because of their economies of scale, because they are doing big projects, they are able to deliver a cost-effective unit, as opposed to you who is building one unit and you are sourcing everything at a very small scale. Therefore, you not get the economies of scale.
I
So
see.
those are some of the factors you have to consider.
Yeah, makes sense. Now, I want to be a landlord. I have my piece of land and you have 9.5%. Can I get KMRC loans and build my house and rent it out?
No, you can build your house, but we encourage you that you are building your house for your occupation.
Yeah.
Because that is what we are encouraging. We are encouraging home ownership. We want more Kenyans to own their own homes. And of course, I know when the company grows and we diversify on the product offering, in future we might consider other models of rentals and all that. But for now, our target is to ensure that each and every Kenyan owns a decent home.
So if I'm a developer or I want to put up a flat, I can't come to KMRC.
You cannot come to KMRC, but you are supported. The reason why you are supported is that KMRC funding is actually giving more Kenyans an opportunity to come and buy your units.
Okay.
That is how now we support the developers. And actually, you've seen a lot of development following where the demand is.
Yeah.
Because KMRC has created demand, you find now developers are playing in that space.
Okay.
Most of the units now are actually 10.5 and below because they are following what we're putting in the market.
Yeah.
Yes.
I mean, if I can't afford it, maybe 10.5, and I'm married, can my wife and I combine our abilities, financial abilities, to afford a 10.5 million?
That is actually highly encouraged.
Okay.
Yes, it works for couples, it works for family members, because what we are looking for is to bring affordability to a home. Because if it is you and your brother and you actually want to own a property and you have looked at all other issues, culture issues, and you not have challenges, then why not you combine forces and build a unit that both of you can actually live in? And that can be supported under KMRC. What KMRC does not support then is limited companies, where it is a company that so the lending is done to individuals. So you, if it's a couple, can actually access these. Even a father and a son can actually combine forces, and where you find that the father has resources and want to support their children, they can actually access the facility and support their children.
So they will put in a joint application.
Yes.
Yeah.
They put in a joint application.
All right. This is the Money Podcast. If you're joining us, we are discussing housing, and I have an expert in the house. This is Geoffrey Maura, head of credit at KMRC, right?
Yes.
And that is a Kenya Mortgage Refinance Company. They're here changing the game on housing, and we just want to understand as a consumer, how do I access the houses? What models are there? How else can I be able to get around the bottlenecks that have actually stopped many Kenyans from getting houses, to take advantage of the opportunities that KMRC is offering? When we are back, we now get into the other aspects of financing your product, dealing taxes, and the limits of incomes that exist whenever you are thinking about owning a house. Is there a limit where you need to think that now probably I should wait? Or is it because we have the 1/3 or 30% rule that does exist? How do you get around this? And also, if, for instance, you are a saver or you have pension, are there opportunities in there that somebody can actually use to still access KMRC? When you are back with Geoffrey Maura. Thank you for joining us on the second half of the housing series on Money podcast. My name is Paul Wafula. I'm joined by Geoffrey Maura, the head of credit at KMRC. That's the Kenya Mortgage Refinance Company. Geoffrey, I have 3 wives, and I want to get a house for each one of them, maybe 3 million, another one 3 million, another one 3 million, because the limit is 10.5, right?
Yes.
How do I go about this?
Thank you, Paul, for that good question. The facility that KMRC is supporting is non-discriminative. So what you're saying is that if that is a family setup that you have, and of course you have documentation to support that kind of establishment, is that then we will look at you from a wholesale perspective. That one, you can support the 3 homes, but the kind of application then you make to the institution is that has to be within the 10.5, because the 10.5 million is per house, is household. And household, here we are looking at Paul and the 3 wife as one household. So what you do then is ensure that you're accommodating all of them within the maximum limit of 10.5. So you can do 3 houses for them at maybe 3.3 million each. But the application, the way it will be documented is that it is Paul and Jane as one facility, Paul and Rose as the other facility, and Paul and Jackie, just to use for argument's sake.
Yeah.
So those 3 then will be considered as 3 loans, but we know Paul is the primary, holder, because maybe you are the one who is servicing the mortgage, and that will be, quite accommodated within the program. So that then accommodates you within the 3 family setups that you have.
That is interesting,
Yes.
and I'm educated.
Yes, but of course we would want a full declaration from the lender so that we are aware.
So, what kind of documentation will somebody bring in this kind of a scenario?
Of course, there must be certificates of confirming that there is either marriage, either customary or religious.
Yeah.
That will be documented,
Yeah.
just to show there is a relationship between these 3, and therefore you are appearing in the 3 mortgages. Then that is confirmed that the reason you are appearing in the 3 mortgages is but you are the primary holder of the 3 homes.
Okay.
Yeah.
So, take us through maybe a blow-by-blow account of the customer journey before they actually end up walking out of an institution with a bank. Or how does this look like?
The first steps I would say is that you have to dream. You have to start by, deciding that you want to buy a house and you are looking at a location. So the moment you target that you want to go and live in this kind of neighborhood because you've seen maybe there are good amenities, the good transport, infrastructure is good, there are good schools, there's good security, and you've done your due diligence in terms of the property values and found that that is something that is within your reach, then you start from there. Secondly, identify what you want to buy. Have you identified a house? Have you identified a piece of land? You say that this is costing X amount of money, and therefore, if I put in a house for this, I can actually afford this. Once you have those, then you approach a financial institution. You go and have a discussion and say, I'm interested in buying or building at X. And these are the vague values that I've checked, and this is the cost of properties around that area. Then they will do what we call a desktop analysis of your income. They'll know where do you work, are you employed or are you self-employed, and what kind of cash flow do you have. Then based on that, then you will start now the conversation of credit analysis. They will ask you then to provide your documentation. Of course, there is the basic documentation, which is KYC. That is your PIN, your ID or passport, and any other document that will support that you earn a certain amount of money, either your business registration documentation or your employment documentation. Then that is where you start. Based on that, they do the first thing is to do a credit review, a credit score. Today we have credit bureaus that hold your information. So they will run your score and see has Paul been a good customer, because you must have some credit history, whether you've been borrowing or you have been banking. So but it could either be your previous borrower or you've been banking. So that is part of your credit history, which will form your score. So based on all that, then they will tell you roughly you can actually qualify for X amount of money. Then once you have that kind of information, now you go and engage the property seller or the person who is selling the plot, and you start now the hard conversation where they give you an offer letter, because it's important that it is written. So with that offer letter saying that the vendor is willing to sell X this property X for this amount of money, then that is now what the bank will need to start the process. Together now with the financial information that the bank will require, they might ask you for 6 months bank statement from wherever you are, either bank statement, M-Pesa statement, or any other document that prove that you earn income. Yeah. So based with all that, then they will actually give you an offer letter. So the bank will give you that you have qualified for X, and these are the terms of the loan that we are going to give you. Together with that, then you now engage the seller of the land with facts that now I'm ready. I've seen your offer to sell to me this plot worth 3 million. I'm now accepting this. Can we now get into a sale agreement? Yeah. So once you have that sale agreement, it means you are either required to pay a deposit, and on the other side, you qualify for a loan because you have you have an offer letter from the bank.
Yeah.
So that is now what you return to the bank, and now they start processing your loan.
Yeah.
Then it moves now from the credit appraisal to the approval. You now move to the valuation process, where the bank has a panel of valuers who will come and value the property just to ascertain the amount that was put on the sale agreement can actually support all that. Once that is confirmed, then it moves now to the next stage, which is the registration, the conveyance process, where the property is transferred from the current owner to you. Then the bank charges that property, and then they're able now to disburse the funds to the vendor. And the process ends there.
Can I get more than one house? Maybe I get that and then I pay. Can I get another house through still KMRC?
That would now futuristic, because I mean, when you look at a mortgage ordinarily, not unless now you have some windfall gain and all of a sudden you've come across very huge amounts of money that you'll be able to go and pay off that 10.5 million. It's quite unlikely that in the coming few years you'll have done that. Yeah. But for now, we are encouraging first-time borrowers who are coming into the scheme. You could have owned another property, but you paid it off, or it is not part of the mortgage arrangement. You still qualify. But for now, we want to accommodate all Kenyans by getting one mortgage at a time.
All right, let's look at your eligibility criteria. We want to know, as a borrower, I mean, before you even walk to a bank, what should you really consider before you know that you'll not be turned away? And if you are maybe properties, what are these kind of properties that are eligible that people can actually buy or access KMRC funding for? Yeah.
So to start with, you need to be a Kenyan citizen, and you could be a resident or an non-resident, meaning that if you are working out of the country but you are Kenyan, you can still be supported to buy a unit for your relatives or for your family at home. So diaspora customers are also part of the equation because they are Kenyans. So that is for the eligible, Kenyan. That is need to be a citizen. Secondly, you need to have some verifiable income. Whether you are doing your hustle, you are an SME, or you are employed, you need to have some documents to prove that you actually have that kind of cash flow. So that is what called a verifiable income. So you need to have some records to show that I sell my mitumba and I earn, on average, I made this kind of money. So you need to be keeping some ledgers to show that actually you have some document to prove that you own. And how is that money accounted for? Does it pass through a bank, a SACCO, or does it go through your M-Pesa statement? So that is where you give evidence. Actually, I earn this 50,000 every month, and you can actually show a record of that. Yeah. Thirdly, you need to have, of course, your KYC documents. You have your ID, you have your passport, you have your some basic utility bills, just to show that you actually service certain outgoings every month, and therefore it shows that actually you can show evidence of some payments you've been making in even where you live. Rent payment can actually, it comes in also as part of the evidence that actually you have ability, because if you've been paying rent of 20,000 for the last 5 years, that is evidence. And most of the landlords today, they have records, very good records of how you pay rent. Do you pay through your M-Pesa, or do you pay through your bank? Have you put a standing order? All that is actually verifiable. So that forms part of your history. You have credit history. So once you do that, and of course you need to know your score, your credit score. Today, to get your annual report from your bureau is free. I think you get one report. You are entitled to one report every year for free from your credit bureau, and most of them are actually they have an app, so you can go to a platform and you'll be able to access your credit score, and that is a very good thing, because then it tells the kind of behavior, the character of Paul. Is it a person who has been paying servicing their obligations, or is it a person who has been defaulting on their obligations? That forms your character as a borrower. So if all those records are in order, you approach a bank or a financial institution, and you'll be able to have that conversation.
Okay.
Yes.
Oh, I see. And then the eligible properties.
Eligible properties, we are looking at, you can either buy an apartment, a standalone, but it needs to have a title. The property need to be a titled property. Yes. That is the most basic thing that it must. So because I know a lot of Kenyans own share certificates on land that is not titled, that for now does not qualify, because that has not gone through the whole process of legal registration. Yes.
So, far-flung parts of this this country, maybe Marsabit and so on, must it be near an urban area or any place that have land?
It will be important that it's it is accessible. Secondly, is a marketable piece of land, and it is served. It has facilities. There's water, there's electricity, there's access to road network. That is important, even for you as an investor, because you are investing. If you're investing in that land, if tomorrow you wanted to offload, to sell in the secondary market, will it be easy to sell? So don't buy a piece of land where you know it is not accessible and nobody else will buy. Yeah. So that is why we encourage people to buy land that is actually marketable.
Yeah.
Yes.
Is there an age restriction in terms of, at what point do you say I'm too old to access the KMRC loan? And also, what is the term?
So in terms of age, I'll start to look at, you need to have a majority age to contract. And today, I think in Kenya, is once you are 18 years, you are free to contract. Yeah. So that is the minimum age. Maximum age, it depends with so many other factors. One is that a mortgage requires you to take insurance, because your life as a customer, a borrower, need to be insured, that in case of death or incapacitation, the mortgage will be settled by the insurance company. Secondly, so that determines the extent to which a bank will be able to engage you if you are at a certain age. So you need to be within the insurable age. Today, insurable age runs up to 71 years in Kenya. Yeah. So meaning that you need then to work backward and say, if you want to take a 10-year mortgage and the maximum age of insurance is 71, then you need to be within 60 years for you to get that 10 years. So work backward with all that, with that information. If you are employed and you're going to use employment as a source of your loan repayment, and your contract says that you retire at 60 and you want to take a 10-year mortgage, then you work backward and work with 50 years. Yeah. You get. So there are different factors that will determine then what is the maximum age at which you can enter into these agreements.
Okay.
Yeah. The younger, the better, because then you'll be able to get a longer term, which makes it more affordable for you. But it is not discriminative. So you can enter into that arrangement at whatever age, as long as it qualifies within those other requirements.
In our circles, we have what they call development loans or other loans that are not necessarily tied to your maybe capital, where they multiply by 3, and you're allowed to maybe bring collateral, maybe bring a title deed or your logbook, and then they give you some amount that exceeds your savings, for instance. In this arrangement of KMRC, for instance, can I bring an asset, or can you use an asset to help me get a higher amount of a loan than I would actually qualify if you actually used my income levels?
In fact, when you look at these kind of setup, is that the asset that you are going to use as security is a property that you are buying. That is why we are talking about the loan to value ratio, is that they will look at what is the valuation of that property. Is it 10 million? If it's 10 million, it means that the bank can give you that 10 million.
Yeah.
So that is the first aspect of looking at it from a collateral perspective. The other bit is to look at from an income perspective. How much can you afford? Because I cannot give you more than what you can afford to pay, because then that would be overlending. So whether you bring in an additional asset, it will not qualify you because you don't have ability to service that loan.
Yeah.
You get? Yeah. Yes. So they look at those two aspects: the ability to pay and the collateral that you are giving, the security that you are offering. Yeah. That is now what makes, and that is why within the eligibility criteria, there is what we call a debt ratio.
Okay.
That you should not exceed 66% of your income. Not more than 66% of your income should go toward the loan repayment, because in the country there's a rule that you need to retain at least a third of your income, and that is an income tax requirement. A third of your income need to be retained. All right. At whatever point. Therefore, we are saying we allow you to use any other surplus towards loan repayment. Yeah. But of course, you still have other costs, other running costs on every month. Yeah. You still have bills to pay. Yeah. You still have school fees, food. All those other things need also to be taken care of, so that you don't get into a mortgage arrangement and your children go hungry. Yeah. Because then it will not be a good investment.
Yeah. So basically, for every 10,000, if you make 10,000, for instance, 6,600 is the maximum.
Can actually go towards that. But of course, you consider also the other outgoing, there are taxes that you need to pay, the other utilities that you need to service in a monthly basis. So you need to accommodate all those other outgoings.
I mean, on the land itself, for instance, we have the leasehold and the freehold titles. Yes. Is there any limitation?
No, there is no limitation. You can either do freehold or leasehold. But for leasehold, because it comes with the issues of reversionary interest. So what we say is that if you are taking a leasehold, at least at the point of you look at the tenor of the loan, you need to have some allowance. So if your property has 20 years to expire, the lease to expire, you cannot take a 20-year mortgage. Yeah. Because it means is that you are cutting it so close. Yeah. And you see there is a process of extension of leases. And it goes through a lengthy process through the land registration. Yes. So you need to allow yourself some time for that extension of lease, so that it does not put your property into, at risk. Okay. So that's why we bring in at least allow yourself another 10 years there, so that, because imagine when you're taking a 20-year mortgage, you also need to consider that in case of any challenges with the servicing of the loan, you need to allow yourself some time to restructure the loan. Yeah. So you can find that you've taken a 20-year mortgage, but you will end up paying for 25 years because you need a bit of restructure. Yeah. So if you had only taken a property that has only the 25 years, you are cutting it too close. Yeah. So give yourself some room so that it can allow you to restructure the loan. And secondly, it also allows you to extend the lease, the lease on that property.
All right, talk about mortgage relief, because this is something that has come up quite often on engagement with our listeners. They really want to understand mortgage relief. How does it work in this kind of arrangement with KMRC?
So the way mortgage relief works is that government has recognized that a mortgage is a good investment for Kenyans, and they need to use mortgage to own homes. And therefore, what they have said is that for the interest that you are paying, for the monthly interest you are paying, that interest need to be deducted from your taxable income. So if you are paying interest of 10,000 every month, before you compute your payee, you need to remove that 10,000 from your gross income so that you only tax the balance.
Okay.
So in essence, that's what it means.
Yeah.
Previously, this relief was only available to customers who are borrowing through banks.
Okay.
But in the last 2 years, through KMRC intervention, we were able to bring in SACCOs. So the government was able to accommodate all borrowers from banks and from SACCOs.
Let's just break this down a little bit more. So I have 100,000. That is my income.
Gross income,
Gross
yes.
income. And
Yes.
let's say I have 66,000 that I can use to finance or to get a loan.
Yes.
Through this. So let's say I'm using 60,000.
You're using 60,000.
60,000.
Yes.
To repay. So that 60,000, maybe 10% will be about 6,000, right? So that is more or less the interest that I'm paying.
No,
the
you
bank.
don't look at it that way. Okay,
Yeah.
the way it is that first is that when you're taking a loan of the 10.5,
Yeah.
is that the loan for the 15 years or for the 20 years, it is amortized.
Yes.
What we mean by amortization is that there is a spread between what you are paying as interest and what you are paying as principal repayment.
Yeah.
So the principal repayment goes to reduce your initial loan you took.
Yeah.
Your interest is the cost of taking that loan.
Yeah.
So when you look at your schedule, your amortization schedule, you will find that the loan is reducing by the principal element only,
Okay.
because the other portion of called interest is the cost of borrowing.
Yes.
Now, at the beginning, the interest component is usually higher than the principal component
Yeah.
on a repayment.
Yeah.
That is how the amortization works. So in your case, when you've taken that 66,000, you
Yeah.
might find that 60,000 is actually interest and 6,000 is a capital repayment.
Okay.
So you get a very big relief
At the beginning.
at the beginning.
Yeah.
Yeah. So you'll find that in the computation of relief is that they will take that 60,000, which is the interest, they remove it from the 100,000 that you earn, they
Yeah.
only tax the balance.
Okay.
You get?
So at the beginning, it's actually lighter. to
It's
own.
lighter
Yeah.
in term because you get
Yeah.
a bigger relief.
Yes.
Yes.
Yeah. Okay.
Yes. And that is a big benefit
Yeah.
because that is the only product where government has allowed you to get a relief.
Yeah.
Yeah, it is only that and insurances that you pay. I think insurances that you pay also attract that kind of relief.
Yeah.
Yeah. So any other loan you are taking, any development loan, those loans you are talking about from the SACCOs, any other personal loans, you can't get that kind of relief.
Oh,
That is why we are
interesting.
telling people, stop buying properties using personal loans, get a mortgage.
All right, that's a good place to be. I have taken a loan before, let's say before KMRC came on board, and I took these expensive house loans, maybe they're now at 16% or thereabout, and I want to convert it into a KMRC loan. Is that possible? Because I can convert my other loan to a SACCO loan. Is there a window for somebody who has an expensive loan that they are unable to repay currently?
Yeah, so what we did is that we did a review, a study in the market, and we realized that, of course, the reason why people take other type of loans to finance home ownership is because of some of the challenges. You know, land registration is a bit hectic. It takes a long time, and maybe you've been given, timelines by the developer that you must pay by this time for you to get this kind of relief. So because of those challenges, you find that people will go quickly and get a personal loan and come and buy a property. But this personal loan is running for 5 years, and it is a commercial rate of 18%. That is very expensive. So what we did in the for loans that were taken in the last 2 years, and precisely we came up with a specific date. KMRC started lending on 1st of April 2021. So we said from 1st of April 2021, all loans that were taken in the market, as long as they fit within the criteria, that it was a loan of 10.5 million, it was for a home, you're buying a property for your occupation, you can actually convert that loan to a KMRC product. So you can go to your financial institution and tell them, I took this loan and this money, and actually the banks are able to trace that we gave you a personal loan and we paid, some of it is even paid directly to the developer.
Yeah.
And this property is actually now sitting under your name. You can actually go and use that to convert that loan into a mortgage under KMRC.
Okay.
So you just need to talk to the banks. For those customers who also took mortgages at commercial rates within the same period, because maybe the institution you are working with had not accessed funding from KMRC or had not joined the program, you can still convert that. So you either convert that within the institution, or if the institution does not accommodate, you can transfer that loan to another institution that is participating with KMRC, and you get a concessional fixed funding.
That's quite a big development.
And that has transformed the mortgage, spectrum.
I'm sure people are going to be knocking on your doors. Will you?
Some actually come to us thinking that they can borrow directly from KMRC.
From your offices.
Yeah, but we are happy to direct them to the institution that are offering the product.
I mean,
on
you
our
should
behalf.
consider directly moving into the space.
It's a strategic, initiative, because the reason why we did not take that route is then it becomes very expensive. Because you can imagine, then I'll need to have 100 employees or 200 employees to manage Kenyans. We are talking about how many Kenyans that would want mortgages? Maybe 5 million, maybe 10 million.
Yeah.
How do we accommodate them within such a small institution?
Yeah.
The reason why we adopted this model is that we already have established a model that is working. We have banks and circles that are already serving the market. Use the same channel that is working instead of creating another bank
Exactly.
to come and compete.
There's this income cap issue that keeps coming up. Is there an income cap in terms of how much somebody can, I think it was it 2 million? Was it, how much was it before?
So what happened is that over time we have kept on reviewing our product offering. You remember when we started the program in 2021, the maximum loan we could give was 4 million. That has now moved to 10.5 because we have to change with the market.
Yeah.
Initially, when we started, we had an income cap that Kenyans who could qualify had to earn 150,000 and below.
Yes, 150.
That has since been removed. We no longer have any income capping. So to accommodate more Kenyans. So as long as you have a verifiable income, you can come and borrow, as long as you are borrowing within 10.5 million. So what we are remain with is the capping of the amount of loan you can take, because also we want to serve the lower market.
Okay.
Yes.
And if I have my other money, can I get 10.5 and then top it up?
Yes. I mean, you can buy a property of 15 million where you have put in a deposit of 5 and you borrow the other balance through KMRC. That is because also we understand there are people who have saved, and you need also to accommodate them within the program.
Wow, this is quite a lot to be packed in one podcast or one episode. I mean, Geoffrey, there are those questions that Kenyans have been coming to you in terms of what are those things that they are really interested in having you look at and change. What should we expect from KMRC in terms of adapting to the new maybe requirements or demand from the market?
Actually, in the recent past, what we have seen is that increasingly we are also looking at sustainability as a big component of our funding, and we are looking from the kind of properties that are coming in the market. Green mortgages is actually the next frontier. That we have a lot of interest from the international market on funders who would want to come and fund green mortgages in this country. So we are in discussions with developers to see how can we then expand that space. We need to have sustainable mortgages. By sustainable, we mean that the use of energy need to be very efficient, use natural materials that are not detrimental to the environment, and that will make our homes more conducive for everyone else. And actually, that's the direction to go. So we've seen a few developers who are actually putting in a lot of that, including even the way they design their homes, that you have more of open spaces, green spaces, the wall-to-window ratio. You look at that so that you don't, during the day, you don't have to have artificial lighting. So the natural lighting, and that saves on energy. Yeah. So those are some of the things we are looking at, and I believe we are open to more and more discussions. Of course, rent to own is also another component that is coming up. There are those Kenyans who would feel that they would want to get into those arrangements of tenant purchase scheme or rent to own, as opposed to an outright mortgage.
Yeah.
Those are actually discussions we are having with the key players in the market to see how we can accommodate all Kenyans.
Okay.
Yeah.
All right. Thank you, Geoffrey. That is actually the 30-point mark, and that is all the time we have for this particular episode. If you're joining us, this is the Money Podcast. We are discussing houses, and we have Geoffrey Maura from KMRC. He's taken us through the customer journey and just what you need to do to actually get that 10.5 million single-digit loan. And we've also realized that there is no longer an income cap. So whatever amount you earn as a salary or whatever from whatever source of income, and we have 80% of Kenyans actually in the informal sector. Geoffrey says you can actually just be able to demonstrate how much you make, and then you are able to actually access this funding. And in our next episode, we'll be discussing how the vetting really is done to make sure that the house that you're buying, it's safe and you'll not find a problem with it in the future. We'll also be looking at rent to own as a new initiative, just to understand how this will play out as even KMRC experiments on this new development. My name is Paul Wafula. Thank you for watching, and do what all podcasters always ask you to do: share, like, subscribe, comment, and let us know what we really need to discuss next time. Give us the questions for our guests so that you can be able to answer them here on the podcast. Geoffrey, thank you for coming.
Thank you, Paul. This was quite nice, and we hope that we are going to serve more Kenyans and ensure that we create value for our citizens.
Right.
More Kenyans to own their homes affordably.
Right.
Yes.
More of you to own houses affordably. That's the place we end this podcast. Thank you for watching. Bye-bye. See you next time.